Welcome to the deep dive. Our listener today dropped a stack of sources on our desk that covers, well, everything from shaky jobs numbers to the global race for AI dominance.
It's a huge amount of information, for sure. But our mission today is pretty clear. Filter this financial noise into something you can actually use.
And a theme is definitely emerging.
A huge one. What we see is this defining tension for 2026. On one side, you have this undeniable, resilient optimism, particularly in corporate earnings.
Right.
But that optimism is constantly fighting some major fragilities in the labor market and, in Washington, D.C.'s policy gridlock.
So today we're going to unpack that jobs report drama, what those kind of scary unemployment figures really mean for you. Then we'll look at why corporate America is so incredibly bullish on 2026, despite all this chaos.
And we'll dive into the status of three massive policy battles.
Mm.
The future of ACA subsidies, the whole EV charging infrastructure fight, and big tech's push to fast-track its AI build-out.
We also have a few surprising market reversals to discuss, including why the price of the world's most exclusive handbag is suddenly cooling off.
And we'll wrap up with the next big wave of convenience coming to consumer health.
Okay, let's unpack this macroeconomic foundation first. The jobs report. This one was delayed, and when it finally landed, it was immediately confusing.
Yeah.
It had numbers that looked good on the surface, but the revisions were brutal.
Brutal is exactly the right word. The headline showed 64,000 non-farm payroll jobs created in November.
Which beat expectations, slightly.
It did. It beat the market's low expectation of 45,000. But that little piece of good news just vanished when we looked backward.
I was shocked by that revision.
You should be. October's job creation was sharply revised down by over 100,000 jobs lost. So if you step back and look at the whole labor market since the spring, we've seen very, very little net job growth. It's like a treadmill, not a marathon.
And the unemployment rate jumped up to 4.6%.
The highest since late 2021.
But what really stands out to me in these sources is the broader, more encompassing U6 rate. That includes people who've stopped looking for work and those stuck in part-time jobs. What is that telling us?
That's the real indicator of labor market health, and it's flashing yellow. The U6 rate swelled to 8.7%, also its peak since mid-2021.
So what does that mean for the average person?
Well, what it means for you is that while the official unemployment number seems low, if you lose your job, finding a comparable full-time replacement is becoming significantly harder. The underlying demand for labor just isn't there.
Which explains the concentration.
Exactly. It explains why over 70% of that net job increase, 46,000 jobs, came from just one place: healthcare.
Okay, so if the jobs picture is this fragile, what does that mean for the Fed and interest rates? I mean, they've already approved 3 rate cuts since September.
The fragile job story absolutely keeps the pressure on the Fed to ease policy, but they're being cautious. Interestingly, the market's expectation for an immediate cut in January stayed pretty low, around 24%. The long-term outlook, though, is changing. ING predicts the Fed will keep lowering rates to a more neutral setting of around 3.25% in 2026, driven by this weakness.
And if there's a change in leadership at the Fed, there's talk of a more dovish chair being appointed in May. That could speed things up, right?
Oh, absolutely. It definitely tilts the risks toward faster easing.
Now let's widen the lens a bit. If the U.S. is actively cutting rates, the global picture looks very different. What's the core difference between the U.S., Europe, and Japan right now?
The core difference is that the U.S. is responding to, well, recessionary signals, while Europe and Japan are generally still tightening or just holding steady.
Right.
The European Central Bank, they're in what they call a good place. Inflation is near 2%. Growth is positive but sluggish. So the bar for them to cut rates is incredibly high. Their base case is basically no rate moves for the next 2 years.
They're focused on structural problems.
Precisely. And meanwhile, the Bank of Japan is actually normalizing its policy.
Yeah.
As they're finally raising rates slowly. Projections have their policy rate hitting 1.0% by the end of 2026.
So while the U.S. is stepping on the monetary gas, our major counterparts are either holding the brake or tapping it lightly.
Got it.
And to wrap up the macro segment, we have to talk about oil. The price plunge. WTI crude is trading near $55 a barrel. That's the lowest since early 2021. This is supposed to be good for consumers, but what risk does it signal for the economy?
Well, you're right. Lower oil prices are usually a win for drivers. But a sustained plunge like this, down 22% year-to-date, the worst performance since 2018, it signals a major risk: oversupply coupled with weakening global demand forecasts.
What's driving all that supply?
Two main factors. First, there's a looming surplus from OPEC, plus possibly restoring some output. And second, you have surging non-OPEC production, especially from the Americas. But there's something else priced in here, and it's crucial. Lower geopolitical risk. The possibility of a Ukraine peace agreement would likely ease restrictions on Russian oil, which reduces the market's fear of a supply shock. So the double-edged signal, relief at the pump, but maybe less faith in overall global economic strength.
Here's where that tension you mentioned really begins. Despite all that macro fragility, the choppy jobs market, the risk signal from oil corporate America is hugely, almost historically optimistic, especially when you look at the S&P 500 earnings outlook for 2026.
The projections are truly aggressive. I mean, analysts expect calendar year 2025 to close with 12.1% earnings growth for the S&P 500.
And that would be the second straight year of double-digit growth.
Not only that, but the estimated net profit margin, nearly 13%, would be the highest since we started tracking this data back in 2008.
And 2026 is forecast to be even better.
Yes. Analysts project earnings growth of 14.5% and revenue growth of 7.1%. But here's the crucial insight. This entire forecast is overwhelmingly driven by big tech.
Just tech.
The information technology sector is expected to lead growth at over 23%. And specifically, the Magnificent Seven companies are expected to grow earnings by 22% in 2025.
Okay, compared to what for everyone else?
Compared to just 9% for the other 493 companies.
Wait a minute. If the Magnificent Seven are driving all the growth, should we even care about the rest of the 493 companies? Doesn't that mean the market's optimism is extremely narrow and, well, vulnerable?
That is the million-dollar question you have to ask yourself. The optimism is highly concentrated, and that leads directly to the valuation alert. The forward 12-month price-to-earnings ratio for the S&P 500 is 22.5.
Which is high.
It's notably higher than the 10-year average, which is closer to 18.7. Investors are paying a premium based on faith in continued tech-driven performance.
So if the analysts are forecasting a target price of nearly $8,000 for the S&P 500 in 12 months, a massive 15.5% upside, how much weight should we actually put on that number?
Not much, historically speaking. We cite this specific target not because it's a guarantee, but because it shows the consensus extreme. Historically, analysts consistently overestimate the final price of the index.
By how much?
If we look at the last 2 decades, they have, on average, overshot the actual year-end price by about 6%. So, factor in some healthy skepticism.
From the soaring valuations of tech, let's look at a sector grounded in physical reality and facing massive friction. Commercial real estate. The sources suggest the CRE recovery has paused.
It definitely has. Sentiment is still optimistic, according to industry surveys, but the recovery itself is stuck.
And the top concerns are all about money.
All about money. Capital availability, elevated interest rates, and the overall cost of capital.
The debt mountain is really the defining feature here, right?
Absolutely. More than half of all survey respondents face a property loan maturity in the coming year, but only 1 in 5 expects to pay those loans off in full.
And that's because the interest rates have completely changed the game.
Totally. You have to remember, many of these loans originated back in 2022 when the average commercial mortgage rate was around 3.9%. Today, it's closer to 6.6%. That jump just squeezes cash flow and makes refinancing extremely difficult.
So where are the opportunities now?
Digital economy, properties, data centers, cell towers, that's still the top asset class, driven by that AI build-out we just discussed. But surprisingly, downtown and suburban office space is seeing a slight rebound.
Why is that?
It's driven by record-low new construction and that ongoing push for return-to-office mandates.
That transition from corporate debt brings us to consumer sentiment and the ultimate luxury marker, the Hermes Birkin bag market. We hear about Jane Birkin's personal bags selling for millions.
Right, which suggests booming demand.
But what's the reality for the resale market?
The reality is a fascinating reversal, and it's tied directly to consumer friction. While those celebrity sales are huge outliers, the overall auction prices for secondhand Birkin and Kelly bags are sliding from their pandemic peaks.
How much of a slide are we talking about?
The average resale premium, how much above retail they sell for, fell from over twice the original price in 2022 to just 1.4 times in November.
Why? Is the exclusivity gone?
Not exactly. Luxury experts point to 2 things. Inflation is finally hitting the aspirational luxury consumers, the people buying secondhand to get into the market. And counterintuitively, there's a rising supply in the resale market.
People are selling their bags.
Exactly. When general consumer wealth gets pinched, high-value assets sometimes get sold off, which increases supply and pushes down that premium.
Okay, now we shift into high-stakes political policy. Let's start with the immediate crisis looming over ACA subsidies. The enhanced premium subsidies are likely set to expire at the end of the year.
They are. The risk became acute after the House Speaker reportedly blocked a vote on extending them. And this is a massive issue. These subsidies currently support 22 million people.
What is the estimated impact on their budgets if these just disappear?
The impact would be immediate and severe. KFF estimates that premiums for those 22 million recipients could more than double in 2026. This would cause an estimated 4.8 million people to just drop their coverage, leading to a major public health disruption.
The argument against the subsidies often centers on fraud. So how should we, as listeners, contextualize that fraud debate?
It's a classic political conflict where both sides are using facts to support their case. Republicans correctly cite documented cases of misuse. They point out that, for example, less than half of 1% of deceased individuals received a premium credit.
Okay.
Health policy experts counter that the overall magnitude of the fraud is trivial relative to the scale of the program, meaning the total dollar amount lost is minuscule compared to the benefit provided.
So the conflict is whether minor documented misuse justifies dissolving the whole expansion.
That's the heart of the debate.
Moving to another policy clash, we have 16 states and D.C. suing the Trump administration over EV infrastructure funds. Over $2 billion is being withheld.
This is a crucial policy fight. It really illustrates the tension between political ideology and market adoption. The administration has been openly hostile to EVs, ordering a halt to spending from the primary $5 billion EV charging build-out program earlier this year.
And this friction is happening right as the market seems to be slowing down on EVs itself.
It's the perfect storm. You have automakers like Ford pivoting hard away from their ambitious all-electric plans to focus on hybrids and more fuel-efficient gasoline vehicles instead.
They're responding to consumer resistance.
Directly. Consumers are citing range anxiety, price, and a lack of reliable charging. So the government is slowing the infrastructure build-out just as the automakers are losing faith in the pure EV future.
Let's pivot to big tech's push to accelerate its infrastructure build-out, the SPEED Act. The House recently advanced this, backed by OpenAI, Meta, Microsoft. What does this push for fast-tracking permits actually look like?
This is a core regulatory battle over the future of AI. Big tech wants to fast-track permits for these massive energy-hungry AI data centers and semiconductor plants.
And the main way they want to do that is by weakening environmental laws.
Essentially, yes. The core mechanism is weakening the 1969 National Environmental Policy Act, NEPA, by drastically shortening the timeline for federal reviews and, critically, slashing the statute of limitations for legal challenges from 6 years down to just 150 days.
The message is, regulation is too slow. We need speed to win the global AI race against China.
Exactly. But there's an irony here. The energy demands are so enormous that the push for speed has created political opposition from the ultra-conservative Freedom Caucus, who disagree with this specific amendment, and from Democrats who want guarantees that this fast-tracked energy will prioritize clean energy.
A clash of speed versus environmental protection.
For sure.
And finally, let's look at cannabis reclassification. Rumors of an executive order are creating massive excitement in the market.
This is truly a holy grail scenario for cannabis investors. President Trump is strongly considering moving marijuana from Schedule I, the same as heroin, down to Schedule III, putting it alongside Tylenol with codeine.
What does that reclassification practically mean for the industry?
It would ease the devastating tax burdens they currently face, open up major banking opportunities that are now blocked, and dramatically reduce research barriers. The market reacted instantly. Tilray brands, for example, surged over 27% on the speculation alone.
We also saw a mention of a Medicare angle to this.
Yes. The proposal might include a pilot program for CBD products aimed at seniors. Advocates see Medicare reimbursement for any cannabis product as the critical unlock for attracting institutional capital into the sector.
But there's a controversy there.
Of course. Critics argue this move is way outpacing the clinical science on CBD efficacy and safety, especially for seniors who are already on multiple medications.
Okay, let's look at two pieces of consumer-facing news that will hit your personal finances and health directly in the coming year. First, this incredible shift coming to weight loss treatments with the launch of oral GLP-1 pills.
2026 is poised to be the launch year for new oral GLP-1 pills from Novo Nordisk and Eli Lilly. And this is a game changer. It addresses a massive point of consumer friction. injections.
A lot of people just don't want to do that.
Exactly. These pills offer a more convenient, potentially cheaper alternative for patients who are needle-averse or who just view their weight management needs as less severe.
The convenience is huge, but what about efficacy and market share?
The efficacy data shows really strong results, though they vary slightly. Novo Nordisk's oral semaglutide showed greater weight loss in trials up to 16.6% compared to Eli Lilly's forglipron, which was up to 12.4%.
Interesting.
But despite Novo Nordisk leading on weight loss, Goldman Sachs analysts predict Eli Lilly's pill could still capture 60% of the daily oral segment by 2030. That's over $13 billion.
And the cost incentive is baked in, which is critical for mass adoption.
Absolutely. Both companies are planning discounted starting doses, maybe as low as $149 a month via direct-to-consumer websites. That price point aims to maximize accessibility, especially when you compare it to the really high list prices of the injections.
Finally, as the year closes out, a lot of us are focusing on clearing small credit card balances, that final push. We need actionable knowledge, not just general advice. What 5 unique strategies emerged from the sources to help listeners cross that finish line?
Okay, we can group these into 2 categories: instant cash sources and quick earning methods. First, instant cash. 1, redeem your credit card points specifically as a statement credit. It's not the highest value, but it instantly wipes out part of your balance.
Okay, that's a good one.
2, use cashback browser extensions like Rakuten for any last-minute shopping. Those quarterly payouts can arrive right when you need them. And 3, quickly monetize your unused clutter. Apps like Mercari or Depop are super fast for getting small chunks of cash.
So that's 3 ways to generate immediate liquidity. What about quick earning methods?
The final 2 are about generating income fast. 4, use gig platforms like Upwork or Fiverr to pick up small, quick freelance tasks. The goal isn't a career change, it's $50 to $100 in quick targeted earnings.
And number 5.
And 5, this is the most critical for reducing future costs. Dedicate any year-end holiday bonus entirely to that credit card debt. Even a small bonus immediately reduces the principal and minimizes that high-interest debt going into the new year.
So to summarize our deep dive today, market optimism is soaring for 2026, driven almost entirely by projected double-digit earnings growth concentrated in big tech.
But that high-flying outlook is constantly grounded by real macro fragility in the labor market and major policy risks, whether it's the expiration of ACA subsidies or that fight over EV infrastructure funding.
The strong central theme that connected all these segments, from the new weight loss pills to the auto industry's pivot, is that tension between disruptive, long-term innovation and short-term consumer convenience.
Exactly. We saw automakers like Ford pivot away from pure disruptive technology, the pure EV, toward the incremental, convenient improvement of the hybrid car. Why? Because of consumer resistance and friction.
Right.
And simultaneously, advanced health solutions like GLP-1 treatments are becoming drastically more convenient and accessible by coming out in a pill form instead of an injection.
It really makes you wonder, looking ahead to 2026, the question is whether consumers, when they're faced with friction, will overwhelmingly choose the incremental, convenient improvement, the hybrid car, the oral pill, over the disruptive all-or-nothing technology.
The pure EV, the injection, and how that consumer choice will ultimately dictate where capital is allocated, whether it's into tech, pharma, or auto manufacturing. That dynamic between disruption and convenience is the most fascinating thing to watch next year.
Thanks for diving deep with us.